Wall Street is the beating heart of American finance, a place where fortunes are made and lost in the blink of an eye, a symbol of wealth and opportunity where dreams of prosperity are born. But behind the gleaming skyscrapers and the ticker tape parades, there's a darker side to this world, one that most people don't see. It's a side filled with secrets and shadows. Did you know that up to 70% of trades on Wall Street are executed not by humans, but by high-frequency trading algorithms? These algorithms are designed to outpace human traders, making decisions in microseconds. These algorithms, capable of making thousands of trades in the blink of an eye, dominate the market. They operate at speeds and complexities that are beyond human comprehension. This might sound like progress, but it comes with a whole host of problems, and the average investor might just be the one getting played. The speed and efficiency of these algorithms can create an uneven playing field. We're talking about market manipulation, a lack of transparency, and a system that seems rigged against the little guy. Technology is being used not just to facilitate trading, but potentially to exploit it. The very tools designed to help us are now being used to outsmart us. The very foundations of fairness and equal opportunity are being called into question as we enter this new age of high-frequency trading and artificial intelligence. The rules of the game are changing, and not everyone is keeping up. For years, Wall Street has operated under a veil of complexity, hiding its inner workings behind jargon and technicalities that few outside the financial elite could understand. This complexity serves as a barrier to entry for the average person. But it's time to pull back the curtain and ask some tough questions. We need to understand what's really going on behind the scenes, because what's at stake here isn't just the balance of our financial markets, it's the very integrity of our economy. The future of fair and transparent trading depends on it. Let's talk about high-frequency trading, or HFT for short. This is a complex and often controversial aspect of modern finance. This is where the lines between finance and technology get really blurry. It's a world where milliseconds can mean millions. Imagine computers programmed to buy and sell stocks in fractions of a second, far faster than any human ever could. These machines operate at lightning speed. These HFT algorithms are constantly scanning the market for tiny discrepancies in prices, exploiting these micro-movements to make a profit. They are designed to be incredibly efficient and precise. Sounds impressive, right? And also completely unfair. The speed and efficiency of these algorithms can leave traditional traders at a significant disadvantage. Here's the catch. These high-speed trades aren't actually based on any real analysis of a company's value or potential. They don't consider the fundamentals. They're just exploiting tiny, fleeting price differences that exist for mere milliseconds. These opportunities are so brief that only machines can capitalize on them. It's like a high-stakes game of financial whack-a-mole, and the average investor is the one holding a very slow hammer. The playing field is far from level. This speed advantage gives HFT firms a significant edge, allowing them to front-run orders, manipulate prices, and essentially skim profits off the top of the market. It's a game of speed and precision. It's like having a race car on a track full of bicycles, not exactly a fair fight. The disparity in speed and capability is stark and undeniable. Remember the flash crash of 2010? On May 6th of that year, the Dow Jones Industrial Average plunged nearly 1,000 points in a matter of minutes. It was the biggest single-day point drop in the Dow's history, and it happened with terrifying speed. What caused this sudden, dramatic plunge? You guessed it, high-frequency trading algorithms. A single massive sell order triggered a chain reaction across the market, with algorithms rapidly selling off stocks and amplifying the downward spiral. The market eventually recovered, but the damage was done. The flash crash exposed the fragility of a market increasingly dominated by complex algorithms and the potential for these systems to go haywire. For regular investors, the flash crash was a stark reminder that the market can turn on a dime. It highlighted the dangers of relying on a system that prioritizes speed and complexity over stability and fairness. Now, let's talk about the new kid on the block: artificial intelligence. It's a technology that's rapidly transforming various industries, and finance is no exception. AI is changing the game on Wall Street, and not necessarily for the better. While it brings efficiency and speed, it also introduces new risks and challenges. We're talking about machine learning algorithms that analyze vast amounts of data to predict market movements and execute trades. These systems are incredibly sophisticated and can process information at lightning speed. These AI-powered systems can identify patterns and make decisions at a speed and scale that dwarfs human capabilities. They can execute thousands of trades in a fraction of a second, but here's the problem. AI algorithms are often designed with a single-minded focus on maximizing profit. This focus can sometimes overshadow other important considerations. Ethics, fairness, those are afterthoughts at best. The primary goal is to generate as much profit as possible, often without regard for the broader impact. This relentless pursuit of profit can lead to unintended consequences. Market volatility can be exacerbated, and small errors can snowball into significant issues. AI algorithms trained on historical data might miss crucial nuances or fail to adapt to changing market conditions. They rely heavily on past trends, which may not always predict future events accurately. And when these algorithms make mistakes, they can make them on a massive scale. The repercussions can be felt across the entire financial system. Remember, these machines are designed to learn and adapt, but their learning is based on maximizing profit, not ensuring a level playing field for everyone. This raises important questions about the future of finance and the role of AI in it. Section 5. The Black Box of Wall Street. One of the biggest problems with high-frequency trading and AI in finance is the lack of transparency. These complex algorithms operate in a black box, their inner workings hidden from public view. We don't know exactly how they work, what data they're using, or who's ultimately benefiting from their trades. This lack of transparency creates a breeding ground for suspicion and distrust. It allows for potential market manipulation and unfair practices to go unchecked. Imagine a casino where the house doesn't have to reveal its rules or how the games are rigged. That's essentially what's happening in the financial markets today, thanks to the opacity of these high-tech trading systems. Section 6. The Illusion of Control. Here's another thing to consider. Even the people who design these algorithms may not fully understand how they work. These are complex systems that can evolve in unpredictable ways, especially when they're interacting with other algorithms in the market. It's like trying to control a swarm of bees. You can try to steer them in a certain direction, but ultimately their collective behavior is determined by a complex web of interactions that you can't fully predict or control. This lack of control is a recipe for disaster. It creates the potential for unforeseen consequences, flash crashes, and market instability, and when things go wrong, it's often the average investor who's left holding the bag. Section 7. The Price of Inequality. The rise of high-frequency trading and AI in finance is exacerbating existing inequalities in our economy. The average investor, lacking the sophisticated technology and resources of Wall Street giants, is at a significant disadvantage in this high-speed, algorithm-driven market. It's like trying to compete in a marathon when your opponents are all driving Ferraris. The playing field is far from level, and the gap between the haves and have-nots is only widening. This isn't just bad for individual investors. It's bad for the economy as a whole. When wealth becomes concentrated in the hands of a few, it stifles innovation, reduces competition, and undermines trust in our financial system. Section 8. Can we fix it? So what can be done? How do we address these challenges and create a more just and equitable financial system? The first step is acknowledging the problem. We need to shine a light on the dark corners of Wall Street and demand greater transparency from our financial institutions. We need to understand how these algorithms work, what data they're using, and who's ultimately benefiting from their trades. This transparency is essential for building trust and accountability in the market. Section 9. A call for transparency. We need to implement stricter regulations on high-frequency trading and AI in finance. This includes things like circuit breakers that can halt trading during periods of extreme volatility, as well as rules that prevent predatory practices like spoofing and layering. We also need to invest in better market surveillance tools that can detect and prevent market manipulation and other forms of abuse. Just as we have regulations for food safety and consumer products, we need robust regulations to ensure the safety and fairness of our financial markets. Section 10, leveling the playing field. Finally, we need to empower individual investors with the knowledge and tools they need to navigate this complex landscape. This includes things like financial literacy programs, investor education initiatives, and access to affordable financial advice. We also need to create a more level playing field by providing greater access to technology and resources for small investors. The future of our economy depends on a financial system that is fair, transparent, and accessible to all. It's time to reclaim Wall Street from the high-frequency traders and algorithms and make it work for everyone, not just the privileged few.